Before we begin, please be aware that the content in this video is for educational and informational purposes only. It is not intended to be, and should not be construed as financial, investment, or trading advice. The foreign exchange market is subject to rapid and sometimes unpredictable changes, and carries a high level of risk. Past performance is not indicative of future results. Any decisions you make based on the information presented in this video are your sole responsibility. We are not financial advisors, and you should always conduct your own research and consult with a qualified professional before making any financial decisions. Picture this. It's 3 a.m. in New York City. The neon glow of Times Square has faded to a hum, and Wall Street is a ghost town. But in a quiet, climate-controlled data center just across the river in New Jersey, something is wide awake. It's not running social media or streaming movies. It's an algorithm, a specialized form of artificial intelligence, and it's staring unblinking at the global foreign exchange market. It's processing millions of data points a second, news feeds from Tokyo, economic reports from Sydney, subtle shifts in trading volume from Singapore. It's looking for a whisper, a faint signal in the noise that no human trader, no matter how experienced, could possibly detect. At 3:07 a.m. it finds one, a fleeting correlation between the Japanese yen and a surprise pre-market announcement about Australian commodity exports. Without emotion, without hesitation, it executes a trade. By the time the first traders in Manhattan are hitting the snooze button on their alarms, that single automated decision has analyzed a potential opportunity that many human traders might spend an entire week hunting for. This isn't a scene from a Hollywood movie. This is the new reality of the Forex market. And for the average American retail trader, the person sitting at their kitchen table with a laptop, trying to make sense of the charts, this reality can feel incredibly intimidating. It feels like you're bringing a pocket knife to a drone fight. You've felt it, haven't you? That feeling of being perpetually one step behind. You spend hours studying technical analysis, drawing trend lines, setting your stop losses, only to watch the market pivot on a dime because of a news headline you didn't see coming. You feel the gut punch of a trade going south, or the frustration of exiting too early and leaving potential gains on the table. It's a constant battle against two powerful forces, a tsunami of information you can't possibly process on your own, and your own human emotions, fear, greed, and a lack of patience. But what if you could change the rules of the game? What if you could get your own drone in the fight? What if you could leverage that same powerful technology, artificial intelligence, not to replace your judgment but to supercharge it? That's exactly what we're going to explore. We're pulling back the curtain on the world of AI-powered Forex tools that are being used right here in the United States, from major hedge funds to savvy retail traders. This isn't about some mythical get-rich-quick button. Let's be crystal clear about that. This is about leveling the playing field. It's about transforming you from a passive participant, reacting to the market's every whim, into a strategic operator equipped with a co-pilot that never sleeps, never gets emotional, and can analyze more data in a single second than you could in a lifetime. Over the course of this presentation, we are going to break down the top AI Forex tools available to you. We'll explore what they are, the different categories they fall into, how they actually work under the hood, and the potential ways they can be integrated into a trading strategy. We're going to demystify the jargon and cut through the marketing hype to give you a clear, unbiased look at what's possible. Because the truth is, AI in trading isn't a single thing. It's an entire ecosystem of technologies designed to tackle specific problems. Think of it like a modern-day craftsman's workshop. You have different tools for different jobs. First, you have the AI-powered scouts. These are your analytics platforms and signal generators. Their job is to sift through the mountains of market data, news sentiment, and economic indicators to spot high-probability setups. They're like an advanced reconnaissance team, highlighting potential areas of interest on the map before you even think to look there. They don't place the trade for you, but they dramatically narrow your focus, saving you countless hours of manual chart analysis and helping you avoid the dreaded analysis paralysis. Next, you have the automated soldiers, the trading bots, often called expert advisors or EAs. These are the tools that take a predefined strategy and execute it with machine-like precision. Once you've established your rules, your entry points, exit points, risk parameters, the bot carries out the plan flawlessly. It won't get greedy and hold a winning trade for too long. It won't get scared and close a position prematurely during a minor dip. It operates 24 hours a day, 5 days a week, monitoring the markets while you're at work, at the gym, or asleep. This is where the emotionless aspect of AI becomes a powerful ally. protecting you from your own worst instincts. Then you have the strategic advisors, the AI-driven risk management systems. This is perhaps one of the most underrated but crucial applications of AI in trading. These tools don't just help you find potential wins. They work tirelessly to help you mitigate potential losses. They can analyze your trading history, identify patterns of behavior that are costing you money, and dynamically adjust position sizes based on real-time market volatility. It's like having a seasoned risk manager looking over your shoulder, constantly reminding you to protect your capital, which is the #1 rule of any successful trading endeavor. Finally, you have the fortune tellers, the predictive modeling and forecasting tools. This is where machine learning really shines. These systems analyze historical price action and a multitude of other variables to create sophisticated models that attempt to forecast future market movements. Now, no model can predict the future with perfect accuracy, but by identifying historical patterns and correlations that are invisible to the human eye, these tools can provide a statistical edge, another layer of data to inform your trading decisions. The reason this conversation is so critical right now for the US-based trader is because the landscape is changing faster than ever. We're living in an era of unprecedented market volatility. Global economic policies, geopolitical tensions, and lightning-fast news cycles are causing currency pairs to move in ways that defy traditional textbook analysis. Relying solely on the old methods is becoming increasingly difficult. At the same time, the very AI technology that was once the exclusive domain of billion-dollar Wall Street firms is now becoming more accessible, more affordable, and more user-friendly for the retail trader. The barrier to entry has never been lower. So the question is no longer if AI will change Forex trading for the individual. The question is how you will adapt to this change. Will you be the one left trying to manually analyze charts while the rest of the market is leveraging machine intelligence? Or will you be the one who understands these tools, who learns how to integrate them into your strategy, and who uses them to gain a sophisticated edge? Throughout this series, we will give you the foundational knowledge to begin answering that question for yourself. We're going to start by looking at a tool that specializes in one of the most difficult variables to quantify in trading: human emotion. It uses advanced AI to scan millions of news articles, social media posts, and financial blogs to build a real-time map of market sentiment, giving its users a unique view of the fear and greed that truly moves the market. Imagine trying to listen to a million conversations at once. It's impossible, right? For a human, yes. But for this type of AI, it's just another Tuesday. It doesn't just count keywords. It understands context, sarcasm, and the subtle shifts in language that signal a change in mood. It learns to differentiate between the panicked yelling of a novice trader on a forum and the carefully worded analysis of a seasoned economist in a research paper. It's not just data collection. It's data interpretation on a massive superhuman scale. This gives a trader a sort of sixth sense, a glimpse into the collective consciousness of the market just moments before it translates into price action. To understand why this is so revolutionary, let's talk about something called an information cascade. Think back to a time you saw a currency pair, let's say the euro versus the US dollar, just sitting there trading sideways. The charts look calm, almost boring. Then, out of absolutely nowhere, it drops like a stone. You scramble to check the major news websites, Bloomberg, Reuters, and there's nothing. No big announcement from the European Central Bank, no surprise data from the US. What happened? 10 minutes later, the headline finally breaks. A senior official made an off-the-cuff remark at an obscure press conference, a remark that was picked up by one small local news outlet, tweeted by a handful of journalists, and then spread like wildfire through private trading communities. The sentiment soured in an instant. The AI would have seen this. It would have detected the initial spark, that one local news article. It would have tracked its spread onto social media, noting the increasing velocity and negative sentiment score of the conversation. It would have flagged this as a high-impact, rapidly developing event long before it was confirmed by the mainstream media. For a human trader, this is the difference between reacting to the news and anticipating it. It's the difference between being caught in the cascade and observing it from a safe distance, ready to make an informed decision. So how does the magic actually happen? It's a field of artificial intelligence called natural language processing, or NLP. At its core, you're teaching a machine to read and understand human language. The first step is breaking down millions of sentences into their component parts: nouns, verbs, adjectives. The AI then identifies key entities, like Federal Reserve, interest rates, or inflation. It learns that hawkish in a financial context means a bias towards raising interest rates, something that would be completely lost on a simple keyword search. Once it understands the words, it moves on to scoring the sentiment. Each piece of text is assigned a score, typically from -1 to +1. A statement like "the recent jobs report was incredibly strong," exceeding all expectations, would get a high positive score. A tweet saying, "I'm worried the central bank is behind the curve on inflation," would get a negative score. But here's the brilliant part. The AI also learns to weigh the source. A formal press release from the Bank of England is given an incredibly high authority score. A detailed analysis from a well-respected financial blogger gets a medium score. An anonymous account on Reddit screaming that the sky is falling? That gets a very, very low score. The system aggregates all of this, the content, the sentiment, and the source credibility, to create a single easy-to-read sentiment gauge for any currency pair you're watching. Let's walk through a practical, hypothetical example. You're a trader looking at the Australian dollar versus the US dollar. The technical charts are showing a potential topping pattern, suggesting the price might be ready to fall, but you're not fully convinced. You pull up your AI sentiment tool. For the past week, the sentiment for the Aussie dollar has been mildly positive. But this morning you notice a sharp, downward spike in the sentiment score. It's not a catastrophic drop, but it's significant. Instead of just blindly selling, you use the tool to dig deeper. The AI consolidates the sources for you. It points to a cluster of conversations emerging from commodity trading forums. It seems a new report, not yet widely circulated, is suggesting a potential slowdown in Chinese industrial production. Because Australia's economy is heavily linked to exporting raw materials to China, any slowdown there directly impacts the value of the Australian dollar. This is the missing piece of the puzzle. The AI didn't tell you to sell. It didn't give you a signal. It gave you context. It connected the dots between your technical chart pattern and a fundamental, real-world development. Now, the decision to potentially enter a short position is backed not just by lines on a chart, but by a quantifiable shift in market mood based on new information. That's the power. It's not a crystal ball. It's a high-powered flashlight in a dark room. However, it is critically important to understand that this is not a flawless system. It's a tool, a powerful co-pilot, but the human trader must always be the pilot. AI can and does make mistakes. It can be fooled by complex sarcasm or irony. A headline like "Traders are just thrilled about the latest inflation numbers" might be misinterpreted as positive when it's clearly sarcastic. Rumors and deliberate misinformation can also temporarily skew the data before the AI's source weighting algorithm catches up. The true skill lies in integrating this sentiment data into a pre-existing sound trading strategy. It's a source of confirmation, a red flag, or a new idea generator. It helps answer the why behind a price move. If your technical analysis suggests a buy, and the AI sentiment is strongly positive, that can increase your confidence. If your technicals suggest a buy, but the AI sentiment is plummeting, it might be a signal to pause, investigate, and perhaps avoid a potentially bad trade. The human brain is still the ultimate arbiter, responsible for risk management, position sizing, and the final decision to click the button. So we've established how AI can effectively read the collective mind of the market, translating the chaotic noise of human emotion into actionable data. It gives us an unprecedented view of the narrative, the story that traders are telling themselves about a currency's value. This is a profound leap forward. But it only addresses one side of the equation. It analyzes the human reaction to market events. What if an AI could bypass the human element entirely and analyze the raw market data itself? What if it could look at a price chart not as a collection of candlesticks and lines, but as a complex mathematical landscape? Imagine an intelligence that can scan decades of price history across hundreds of currency pairs in a fraction of a second, identifying intricate, multidimensional patterns that are completely invisible to the human eye. Patterns that repeat themselves with statistical significance, but are so complex and subtle that no human could ever hope to spot them. Reading the news and social media is one thing. But what about reading the hidden language of the market's code itself? That's where our next category of AI tools takes us, and it operates on a completely different, and frankly mind-bending level of analysis. Imagine trying to read a book written in a language you don't understand. You could look at the letters, notice that some shapes appear more often than others, maybe even see that certain groups of letters form recurring words. That's traditional technical analysis. You're recognizing patterns, a head and shoulders, a bullish flag, but you're not truly fluent. You're seeing the shapes but not necessarily the story. The AI tools in this category, they're not just spotting the words. They are fluent. They read the entire book, understand the grammar, the syntax, the subtext, and can make an educated guess about how the next chapter will unfold. This is the world of advanced algorithmic and chart pattern recognition AI. It's a quantum leap beyond drawing trend lines on a screen. Think about the fundamental limitation of any human trader, no matter how experienced. You can only watch a handful of charts at once. You can only remember so many patterns. You get tired. You get distracted. You feel the pull of greed when a trade goes your way, and the sting of fear when it turns against you. These AIs have none of those limitations. They are the ultimate chartists, a legion of analysts working 24 hours a day, 7 days a week, across every single currency pair, every single time frame, from the 1-minute tick to the monthly candle. They never sleep, they never blink, and they feel absolutely nothing. Their first job is pattern recognition on a superhuman scale. We're not just talking about the classic patterns you read about in textbooks. These machine learning models are trained on decades of historical market data. They don't just see a cup and handle. They see thousands of variations of that pattern. They see the subtle differences in volume that accompanied successful breakouts versus failed ones. More importantly, they identify complex, multi-dimensional patterns that don't even have names yet, patterns that might only form when a specific set of indicators across 3 different time frames align in a precise way during a period of low volatility. It's like being able to see in a different spectrum of light. A human trader sees a messy sideways chart. The AI sees a faint, but statistically significant, harmonic pattern forming that has preceded a major breakout 73% of the time in the last 15 years under similar market conditions. That is the level of detail we are talking about. But identifying a pattern is only half the battle. The real power comes from what they do with that information. This leads to the concept of backtesting on an industrial scale. A trader might have an idea for a strategy. For example, I want to sell the pound sterling to Japanese yen pair whenever the 50-period moving average crosses below the 200-period moving average on the 4-hour chart. A human could manually go back through a year or two of data, which would take hours, and get a rough idea of its performance. An AI backtesting engine can take that same rule and test it against 20 years of tick-by-tick data. That's every single price fluctuation, in under a minute. It won't just tell you if it was profitable. It will break it down with ruthless efficiency. It will tell you the maximum drawdown, the average win, the average loss, the profit factor, and perhaps most crucially, it will show you the periods where the strategy completely fell apart. Can then take it a step further. It can run thousands of simulations, slightly tweaking the parameters each time. What if you used a 45-period moving average instead of a 50? What if you only took trades during the London session? What if you added an RSI filter to avoid trading in choppy markets? It stress tests the strategy against every conceivable historical scenario, providing a probabilistic map of its potential strengths and weaknesses. This isn't about finding a holy grail. It's about understanding the precise conditions under which a strategy has historically thrived, and when it has failed. It replaces gut feeling with a data-driven case study. And this brings us to the most futuristic aspect, predictive modeling. This is where AI attempts to forecast the most probable next move. These systems often use a type of neural network called an LSTM, which stands for long short-term memory. It's specifically designed to recognize patterns in sequences of data. Think of it like the predictive text on your smartphone. When you type, "I'm heading to the," your phone analyzes the sequence of words and suggests store, gym, or office based on what you've written before. An LSTM model does something similar with price action. It looks at the sequence of the last 50 or 100 price candles, their highs, lows, opens, and closes, and based on the immense library of sequences it has studied from the past, it calculates the probability distribution of what the next candle might look like. Will it be a long green candle? A short red one? It's not a crystal ball. It's a sophisticated weather forecast for the market, suggesting the most likely short-term outcome based on the current atmospheric pressures of price action. So what does this look like in practice for a trader in the US using these tools? You might have a platform that automatically scans the market and sends an alert to your phone. Potential inverse head and shoulders forming on US dollar to Canadian dollar H1 chart. Historical backtest of this specific formation shows a 68% probability of reaching the 1.3550 price level within the next 12 hours. Confidence score: B+. You, the trader, are still in complete control. You look at the chart, you consider the current news cycle, you assess your own risk tolerance, and you make the decision. The AI isn't your boss. It's your full-time, unpaid, genius-level research assistant. Another example is a market state analysis tool. Many traders fail because they use a trend-following strategy in a sideways-ranging market or vice versa. This AI tool doesn't just look at price. It analyzes the market's behavior. It might classify the current state of euro to US dollar as low volatility range or high momentum uptrend. This classification then helps the trader deploy the right tool for the job. It's like a carpenter's assistant who always hands you the right screwdriver before you even have to ask. It helps prevent you from trying to hammer in a screw. These algorithmic tools are a profound shift from reactive to proactive analysis. Instead of just reacting to a price movement after it happens, traders can be alerted to high probability conditions as they are developing. It's about leveraging the raw computational power of a machine to do what a human brain simply cannot: process billions of data points in real time to find the signal in the noise. The AI handles the heavy lifting of data analysis, freeing up the trader to focus on the bigger picture: strategy, risk management, and the final execution. So we have AI that can read the collective human emotion from the news, and we have AI that can decipher the mathematical language of the charts. They are two incredibly powerful but largely separate streams of analysis. One understands the why, the fundamental story driving the market. The other understands the how, the technical structure and flow of price. But what happens when you fuse them together? What happens when an AI can see a historically bearish chart pattern forming at the exact same moment it detects a subtle shift in tone from a Federal Reserve official's speech? That synthesis, that's where the next generation of trading technology is heading. And it's also where we introduce the AI designed to protect you from the single biggest liability in any trading account: yourself. Let's talk about the human element. Because every sophisticated algorithm, every lightning-fast execution platform, every predictive model ultimately has to answer to the person sitting in the chair. The person who gets greedy. The person who gets scared. The person who gets tired and makes a simple catastrophic mistake. The greatest edge in trading isn't finding the perfect entry. It's conquering the emotional roller coaster that makes you deviate from your own winning plan. And for that, there's a new class of AI emerging, one that doesn't look at the charts but instead looks at you. Imagine a trader. Let's call him David. David is smart. He spent a year backtesting a strategy on the euro to US dollar pair. He knows his system has a 65% win rate and a 2-to-1 risk-reward ratio. Mathematically, over the long run, he should be profitable. He has the blueprint for a successful trading career. But 6 months into trading live, he's down 30% of his capital. What happened? The math didn't change. The strategy didn't suddenly stop working. David happened. On Monday, he took a small loss, exactly as his plan dictated. But it stung. Felt personal. So on the next trade, he doubled his lot size to win it back fast. That trade also lost. Now he's in a deeper hole, his heart pounding. On Tuesday, he sees a setup that's almost perfect according to his rules, but not quite. Fear of missing out, the ghost of yesterday's losses haunting him, makes him jump in early. The market whipsaws, stops him out, and then proceeds to go in the direction he originally predicted. Now he's not just losing money. He's furious. He's angry at the market, angry at himself. By Friday, he's abandoned his tested, proven strategy entirely, and is just clicking buttons based on gut feelings, a disastrous cocktail of fear and hope. He's revenge trading. David's story is the story of an estimated 90% of retail traders. Their failure isn't one of intellect. It's a failure of discipline. It's the psychological gap between the strategy they know they should follow and the emotional decisions they actually make in the heat of the moment. For decades, the only solution was years of painful experience, meditation, or hiring expensive performance coaches. But now AI is stepping into that role. Enter the AI-powered behavioral guardrail. Think of it less as a trading tool and more as a personalized psychological co-pilot. One of the most fascinating platforms being adopted by small prop firms in the US and sophisticated retail traders is designed to do one thing: learn your specific trading pathologies and intervene in real time. Here's how it works. When you first install this software, it runs in the background silently observing. It's not looking at indicators. It's looking at your behavior. It logs every single click. How long do you hesitate before entering a trade? Do you move your stop loss further away when a trade goes against you? A classic sign of hope over strategy. Do you rapidly increase your trade size after a series of losses? The textbook definition of revenge trading. Do you trade outside of your predefined market hours, like trying to scalp the Tokyo session at 2 a.m. when you're exhausted and your strategy is designed for the London-New York overlap? The AI isn't judging. It's just collecting data, building a psychological fingerprint of you as a trader. It identifies your personal tells, the same way a professional poker player reads an opponent. After a week or two of learning, it activates. Now let's rerun David's terrible week, but this time with his AI co-pilot active. On Monday, he takes that first small plan loss. It still stings. He goes to the lot size box on his platform and tries to double it for the next trade. Instantly, a polite but firm pop-up appears on his screen. It doesn't just say warning. It says, David, our analysis shows that 87% of the trades you have placed immediately following a loss with more than a 50% increase in risk size have resulted in a negative outcome. Your own trading plan specifies a maximum 1% risk per trade. This action represents a 2% risk. Are you sure you want to override your own rules? He's stopped in his tracks. The AI isn't just a dumb alert. It's holding up a mirror, reflecting his own historical data and his own predefined rules back at him. It's the voice of his rational, calm self from a week ago, speaking to his emotional, impulsive self in the present. He sighs, clicks cancel, and enters the trade with his proper position size. On Tuesday, when he sees that almost perfect setup and his finger hovers over the buy button, the AI intervenes again. This setup does not meet rule number 3 of your trading plan regarding candlestick confirmation. We have also detected an elevated heart rate through your connected wearable device, which historically correlates with your FOMO-based entries. It is recommended to wait for the next candle close. Did you catch that? Integration with wearable tech. This isn't science fiction. It's happening now. The AI is correlating his physiological data, his heart rate, his stress levels, with his trading performance. It knows, based on his own biometrics, when he's about to make an emotional decision versus a logical one. By Friday, instead of being down and desperate, David has followed his plan. He might be slightly down for the week or slightly up, but he's intact. His capital is preserved. His mental state is calm. He wasn't saved by a better indicator or a faster signal. He was saved from himself. These systems can be customized to an incredible degree. Some traders program their AI to completely lock them out of their trading platform for an hour if they break their rules 3 times in a row, a mandatory cooldown period. Others have it prevent them from trading specific currency pairs that they have a history of losing on. For example, if you constantly lose money trying to trade the British pound against the Japanese yen, the AI can simply make that pair untradeable on your platform, saving you from your own worst impulses. This is a paradigm shift. For years, the industry has focused on creating tools to better analyze the market. This new wave of AI focuses on analyzing the trader. It's based on a simple, profound truth. You can have the best car in the world, but if the driver is prone to panic, they're still going to crash. This AI is the world's most advanced driving instructor, sitting right there in the passenger seat. It never gets tired, it never gets emotional, and it bases all of its advice on one single incorruptible source of truth: your own data. It learns that your worst trades happen around lunchtime on Wednesdays. It learns that you get overconfident after 3 wins in a row and start taking sloppy setups. It learns that you're more likely to fat finger an order and type an extra 0 on your lot size when you're trading on your mobile phone versus your desktop. It sees the patterns you are completely blind to. This isn't about taking away control. It's about enforcing the control you wanted to have when you were in a logical state of mind. Every trader writes a trading plan. Almost no trader follows it perfectly under pressure. This AI acts as the incorruptible executor of that plan. It doesn't remove your decision-making ability. It just forces you to consciously acknowledge when you are violating your own system. And that brief moment of forced reflection is often all it takes to prevent a catastrophic error. So we've seen an AI that acts as your co-pilot, your psychologist, and your risk manager. Perfects the human element. But what happens when the AI isn't just watching you, but is watching the market in a way no human ever could? What if it could see the ghosts in the market data? The hidden orders from major institutions that move the entire Forex landscape. That's not science fiction. That's called order flow analysis, and when you combine it with AI, well, that changes the game entirely. Imagine for a moment that every price chart you've ever looked at is just a shadow on a cave wall. It shows you the shape of the market, the outcome of a struggle, but it tells you nothing about the battle itself. You see a long green candle and assume buyers are in control. You see a red one and assume sellers are winning. But what if I told you that was a dangerously incomplete picture? What if you could see the very fabric of the market being woven in real time? What if you could see not just the shadow but the actors creating it? That's the leap from traditional technical analysis to AI-powered order flow. It's like going from a black and white photograph to a live 4K thermal imaging camera. Order flow analysis is, at its core, the study of the raw buy and sell orders hitting the market. Forget the indicators for a second. This is about the most fundamental force in any market. Supply and demand displayed with brutal honesty. You have two types of players. You have the aggressive ones, the traders who hit the buy now or sell now button. They use what are called market orders, and they are the ones who physically push the price up or down. Then you have the passive players. These are the institutions, the market makers who place limit orders. They say, I am willing to buy $100 million of the euro, but only if it drops to this specific price. Or, I will sell, but only if it reaches this high. These limit orders create walls of liquidity, support and resistance levels that are real, not just lines drawn on a chart. Price moves when the aggressors chew through the passive orders. If aggressive buyers are more powerful than the wall of sell orders, the price breaks through and goes higher. If aggressive sellers overwhelm the wall of buy orders, the price tumbles. A traditional candlestick chart just shows you the result of this war. It's the scoreboard at the end of the quarter. Order flow is the play-by-play. It shows you which side is getting tired, who's putting up a desperate defense, and where the real momentum lies. Now here's the problem. For a human, trying to watch this play-by-play across dozens of currency pairs is impossible. We're talking about millions of transactions, a fire hose of data that would overwhelm anyone. This is where artificial intelligence doesn't just help, it becomes essential. An AI can watch this data stream without blinking, and it's not just counting. It's looking for the subtle, almost invisible footprints of the big money. Let's talk about what it's hunting for. One of the most powerful concepts is called absorption. Picture this. The price of the British pound is falling hard. Everyone is selling. Your classic indicators are screaming short. But as the price hits a certain level, the selling just stops having an effect. Thousands of sell orders are flooding in, yet the price refuses to drop further. It's like throwing baseballs at a brick wall. A human might notice this after a while, but an AI sees it instantly, quantifies it. It flags it and says, alert. Unusually high sell volume is being absorbed at this price level with minimal downward movement. What does that mean? It means a massive unseen player, a central bank, a hedge fund, has a giant buy limit order there and is soaking up every single sell order thrown at it. They are quietly accumulating a huge position. That's a ghost in the machine. And when that absorption is complete, the market often reverses, and it reverses hard. The AI can also spot the opposite, which is exhaustion. Imagine the market is in a strong uptrend. Everyone is euphoric, everyone is buying. But the AI notices something strange. With each new push higher, the number of aggressive buyers is actually getting smaller. The momentum is fading from the inside out. It's like a car running out of gas while still rolling up a hill. It looks like it's moving forward, but the engine is about to die. The AI can measure this buyer exhaustion and signal that the trend might be on its last legs, long before the price actually turns over and the classic indicators catch up. This leads to one of the most fascinating applications, using AI to unmask market manipulation. There's a tactic called spoofing. This is where a large institution places a massive order, say $1 billion sell order, with no intention of letting it get filled. They place it just far enough away from the current price to scare other traders. Everyone sees this giant wall of sellers and panics, starting to sell their own positions, which drives the price down. And right when the price gets close to that giant order, the institution cancels it in a microsecond and starts buying up the currency at the new cheaper price they just created. This is highly illegal, but it happens. A human trader would never see it. But an AI can be trained to recognize the digital signature of spoofing. It can see a pattern of large orders appearing and disappearing without being transacted, flagging it as a potential area of manipulation. It's like having a digital regulator watching the market just for you. Let's put this into a practical scenario. A trader in Chicago, let's call him David, is looking at the US dollar to Japanese yen pair. His moving averages have just crossed over, a classic textbook signal to buy. He's ready to pull the trigger, but he glances at his AI order flow tool. The tool isn't giving him a buy or sell signal. It's giving him information. A heat map on his screen shows a massive dark red cluster of liquidity, a huge wall of sell limit orders, just a few pips above the current price. His AI is also flagging a divergence. The price is rising, but the delta, which is the net difference between aggressive buyers and sellers, is actually negative. More people are aggressively selling into this rise than buying it. So what does David see? His old-school indicator says buy. But the AI-powered order flow tool is telling him a completely different story. It's telling him that he's about to buy right into a brick wall of institutional sellers, and that the buying pressure from smaller retail traders is already starting to fail. He's being shown the trap before he steps in it. He waits. And sure enough, the price touches that level, bounces off it like it hit a trampoline, and plummets. The AI didn't tell him to sell. It didn't make a decision for him. It gave him a layer of market intelligence that was previously reserved for floor traders and institutions, allowing him to make a much more informed, much less risky decision. The tools that do this often look like something out of a science fiction movie. You have footprint charts, which dissect each candlestick and show you exactly how many buy and sell orders were executed at each individual price inside that bar. Instead of a solid green candle, you see a ladder of numbers, highlighting where the real battle took place. The AI component analyzes these footprints over thousands of bars, identifying recurring patterns of institutional behavior that are invisible to the naked eye. Now, it's critical to understand this isn't a magic wand. The learning curve for interpreting order flow data is steep. It requires a fundamental shift in how you view the market. Furthermore, these are professional-grade systems. Access to high-quality, tick-by-tick data feeds and the software to analyze it often comes with a hefty subscription. This is not a starting point for someone with a $100 account. The analysis is only as good as the data it's fed. But the principle is revolutionary. It's about moving from guessing what the market might do based on past price, to understanding what the market is trying to do right now based on the real actions of its biggest participants. It's the difference between looking at a weather report from yesterday and having a live satellite feed of the storm that's forming over the horizon. We've just seen how AI can dissect the market's DNA, transaction by transaction, giving us an unprecedented microscopic view. But what about the bigger picture? What about the global news, the central bank announcements, the political shifts that cause tidal waves in the currency markets? How can an AI possibly understand human sentiment in geopolitical chaos? The answer lies in something called natural language processing, and it's reading the news faster and more accurately than any human ever could. Natural language processing, or NLP, sounds like something out of a science fiction movie, but it's the engine behind the tools changing the game for traders across the United States. Think of it this way. A human trader, even the most dedicated, can maybe watch 3 news channels, monitor a dozen Twitter feeds, and keep an eye on the major financial news websites. It's a constant, frantic battle against information overload. Now imagine an intelligence that can read every single financial news article, every central bank statement, every government report, every relevant tweet, and every analyst blog post from around the entire world, all at the same time. And it does this not just every minute, but every single millisecond. That is the new reality. The fundamental problem for traders has always been speed and scale. A piece of market-moving news, like an unexpected interest rate decision from the Bank of England, doesn't just appear on your TV. It first hits a data wire, a specialized, high-speed information service. Algorithmic trading firms pay a fortune to get that data a few fractions of a second before anyone else. By the time a news anchor on TV says, "We have breaking news," the major price move in the pound sterling to US dollar pair has often already happened. The retail trader is left in the dust, reacting to a ghost. This is where NLP-powered AI tools step in, not just to level the playing field, but to redesign it entirely. These AIs are directly plugged into those same high-speed data wires. They ingest information at the speed of light. But here's the crucial part. They don't just read the words. They understand the meaning, the context, and most importantly, the sentiment. Let's talk about sentiment analysis. This is the AI's ability to determine the emotional tone behind a piece of text. Is it positive, negative, or neutral? But for Forex, it's far more sophisticated. The AI has been trained on decades of financial text and the market reactions that followed. It knows, for instance, that the word robust in a Federal Reserve statement is more positive for the US dollar than the word moderate. It can detect the subtle shift when a central banker goes from saying inflation is transitory to saying they are monitoring inflationary pressures closely. To a human, this might seem like a minor change in vocabulary. To the AI, it's a seismic shift in sentiment, a flashing red light indicating a potential policy change is on the horizon. Consider the European Central Bank. The president gives a press conference. She might say a sentence like, "While economic headwinds persist, we are seeing underlying strength in the services sector." An inexperienced trader might hear headwinds and think, "Oh, that's bad for the euro." Another might hear underlying strength and think, "That's good." The AI does neither. It analyzes the entire speech. It cross-references this exact phrasing with thousands of previous speeches. It measures the frequency of optimistic words versus pessimistic words. It compares the tone to the last press conference. It then distills all of this complexity into a single actionable data point, a sentiment score. The dashboard might show the sentiment for the euro shifting from a negative 0.45 to a positive 0.20 in real time as she speaks. The AI cuts through the noise and delivers the signal. These tools also perform something called entity recognition. This means they can identify who is talking, what they're talking about, and which currencies it affects. If a story breaks about a political scandal in Japan, the AI instantly tags it to the Japanese yen JPY. If a new trade agreement is announced between Canada and Mexico, it tags CAD and MXN. This sounds simple, but it creates a dynamic, real-time map of global risk and opportunity. A trader in Chicago can see at a glance that negative sentiment is suddenly spiking around the Australian dollar, and the AI can instantly show them the root cause. A surprise data release about iron ore demand from China, Australia's biggest trading partner. Connecting those dots manually could take a crucial half-hour of research. The AI does it instantly. Let's put this into a real-world scenario with a hypothetical tool we'll call NewsQuant. Imagine you're a trader in New York, getting ready for the big non-farm payrolls, or NFP report. This is one of the most volatile news events on the US economic calendar, capable of moving currency pairs by hundreds of pips in minutes. The old way of trading this event is pure chaos. You have 5 different browser tabs open. One has the official data release page, which you're frantically refreshing. Another has a live news blog. A third has your trading chart. The numbers drop. Let's say the headline is that 275,000 jobs were created. Your brain goes into overdrive. Okay, what was the forecast? I think it was 200,000, so this is good. That's good for the US dollar. But wait, what about wages? And the unemployment rate? You scramble to find the other numbers. By the time you've pieced it all together and decided it's a strong signal to buy the US dollar against the Japanese yen, the US dollar to Japanese yen has already shot up 80 pips. You either missed the move or you're forced to chase the price, entering at a much worse position. Now let's look at the new way with NewsQuant running. 10 minutes before the release, the AI is already working. It has scanned hundreds of analyst previews, noting that the whisper number, the unofficial expectation among top-tier traders, is actually closer to 225,000. It's already established a baseline. The moment the data is released, the AI ingests not just the headline but the entire report in less than a blink of an eye. Your screen doesn't just show you a bunch of numbers. It shows you a clear, color-coded summary. Headline: jobs, 275,000. Impact: highly positive, beats forecast by 37.5%. Unemployment rate: 3.7%. Impact: slightly negative, higher than 3.6% forecast. Average hourly earnings: plus 0.5%. Impact: highly positive, beats 0.3% forecast, signals inflationary pressure, suggesting a more aggressive Fed. The AI instantly weighs these conflicting data points. It understands that in the current market environment, the wage inflation number is the most critical piece of the puzzle for the Federal Reserve. Its master algorithm calculates a final unified USD impact score of plus 8.7 out of 10. A notification pops up on your screen. NFP data indicates significant USD strength. Primary driver: higher than expected wage inflation. Historical analysis shows an 82% probability of follow-through buying in US dollar to Japanese yen over the next 60 minutes. Look at the difference. You went from a frantic, panic data interpreter to a calm, informed decision-maker. The AI handled the chaos. It did the reading, the analysis, and the historical cross-referencing. It presented you with a clear, probability-based insight. Your job is now purely strategic. Where do I want to enter? What is my risk on this trade? How will I manage the position? You are no longer reacting. You are executing a plan based on intelligence that was, until very recently, only available to the world's largest hedge funds. This isn't about letting a machine trade for you. It's about creating a partnership. The AI is the ultimate reconnaissance scout. It can scan the entire battlefield of global information, identify threats and opportunities, and deliver that intelligence to you, the commander, faster than ever before. But you still have to make the strategic decision. You bring the human intuition, the experience, and the risk management. The AI can tell you that a geopolitical event in the Middle East is causing negative sentiment around oil, but it can't feel the underlying fear in the market the way a 20-year trading veteran can. It's this combination, the AI's and human speed and scale fused with human strategic oversight, that is creating such a profound shift. So these tools have given us the ability to read and understand the world's news in real time. They've decoded the language of the market. But what about the market's other language? The one written not in words but in price charts? For over a century, traders have looked for patterns in the squiggly lines of a chart, support and resistance, trend lines, classic formations. Can an AI learn to see these patterns too? And more importantly, with its immense processing power, can it discover new patterns that are completely invisible to the human eye? That's exactly where we're going next, into the fascinating world of AI-powered technical analysis, and what it's uncovering will change how you look at a chart forever. For centuries, traders have stared at charts, searching for an edge. We've given names to the shapes we see in the chaos, the head and shoulders, the double tops and bottoms, the flags and pennants. We've drawn our trend lines, our Fibonacci retracements, our support and resistance zones. And all of this is based on one fundamental tool: the human eye connected to the human brain, a magnificent but flawed pattern recognition machine. The problem is our brains are wired with biases. We see what we expect to see. We find the patterns we've been taught to look for. We are, in essence, looking at the vast infinite ocean of market data through a tiny keyhole, able to perceive only the most obvious, most rudimentary shapes. We've been looking for constellations while the AI is mapping the entire galaxy. What these new AI tools are doing is not just an evolution of technical analysis. It's a completely different species. Imagine you've spent your life seeing the world only in black and white. Then someone hands you a pair of glasses that lets you see in full vibrant color. That's the leap we're talking about. AI doesn't come to the chart with preconceived notions of what a bull flag should look like. It has no emotional attachment to a trend line. It approaches the data with pure, unadulterated mathematical objectivity. It sifts through millions, even billions of data points, every tick of price, every unit of volume across multiple timeframes simultaneously, and it asks one simple question: what correlations, no matter how complex or bizarre, have historically preceded a specific market outcome? The patterns it finds are often things we don't have names for. They wouldn't look like anything in a classic trading textbook. It might be a specific sequence of 5 candlestick wicks of decreasing size, combined with a particular volume spike profile and a subtle shift in the volatility of a correlated asset, like the relationship between the Australian dollar and gold prices. A human could never spot this. We couldn't even begin to formulate the hypothesis to test for it. It's a multidimensional pattern existing in a space our minds can't easily visualize. The AI doesn't just see the chart. It reads the market's DNA, identifying genetic markers that are predictive of future behavior. Let's get specific. One of the most powerful applications of this is in the realm of what we can call hyperpattern recognition. In the US, several emerging platforms are using what are known as convolutional neural networks, or CNNs. Now, CNNs were originally designed for image recognition, to help a computer tell the difference between a picture of a cat and a picture of a dog. Traders and developers realized that a price chart is, in essence, an image. By feeding millions of historical chart snippets into a CNN, they can train it to see patterns far more complex than any human could. It doesn't just find a head and shoulders pattern. It might identify what we could call pattern 7B alpha, a unique 12-bar formation on the Euro to US dollar 15-minute chart that, when it appears during the New York session while the VIX index is below 15, has historically led to a 40-pip move to the downside 78% of the time over the last 10,000 occurrences. That level of granular, data-backed insight was pure science fiction just a decade ago. It transforms chart analysis from a subjective art into a statistical science. But it goes even deeper than just identifying static patterns. The next level is predictive indicators. For decades, we've used indicators that are, by their very nature, lagging. A moving average, by definition, tells you the average price of where the market has been. It's like trying to drive a car by only looking in the rearview mirror. Even so-called leading indicators like the RSI are still just mathematical derivations of past price action. AI is changing this with the introduction of models like long short-term memory networks, or LSTMs. These are a type of neural network specifically designed to recognize and forecast sequences of data, making them perfect for time series data like financial markets. An AI-powered predictive indicator doesn't just plot a line based on past data. It analyzes the recent sequence of price, volume, and momentum, compares it to its vast database of historical sequences, and generates a cone of future possibilities. It might project a visual path on your chart, showing the most probable trajectory for the price over the next few hours, complete with a confidence score or probability bands. It's not a crystal ball. It's not always right. But it's a sophisticated data-driven forecast that gives a trader a glimpse of potential futures, allowing for more proactive, rather than reactive, decision-making. It's the difference between looking at a weather map of yesterday's storm and looking at the meteorologist's forecast for tomorrow. Perhaps the most game-changing concept, however, is what's known as market state analysis, or market regime classification. Most traders have one or two primary strategies, maybe a trend-following strategy and a range trading strategy. The challenge is knowing when to apply which one. We've all been there, trying to use a trend-following system in a choppy sideways market and getting sliced to pieces. AI completely reframes this problem. It can analyze dozens of variables in real-time: volatility, momentum, volume distribution, intermarket correlations, and more, to classify the current market into a specific state or regime. And these aren't just the simple trending or ranging states. An AI might identify a dozen or more distinct regimes: low volatility compression before news, high volume exhaustion climax, mean reversion with upward drift, fractal accumulation phase. It's like a doctor diagnosing a patient. You don't just say the patient is sick, you identify the specific illness. Once the AI has identified the current market state, it can then reference its historical data to tell you which strategies, which entry signals, and even which risk parameters have had the highest probability of success in that exact type of environment in the past. It's like having a seasoned mentor whispering in your ear, saying, "I've seen this exact setup 500 times before. Here's what has worked most often." This moves a trader from blindly applying a single tool to every job, to intelligently selecting the right tool for the specific job at hand, moment by moment. Let's make this tangible. Picture a trader looking at the US dollar to Canadian dollar chart on a Tuesday morning. To the naked eye, it looks like a mess, no clear direction, just random noise. The trader, using traditional methods, wisely sits on their hands, but an AI tool is running in the background. It ignores the obvious noise and analyzes the microstructure of the price action. It detects a subtle decrease in average trade size coupled with an increase in the frequency of trades, a pattern it recognizes as institutional accumulation. Simultaneously, it cross-references this with a slight weakening in WTI crude oil prices, a key correlated asset. The AI identifies this specific combination as regime 4 delta, a market state that, in its backtesting of petabytes of data, has preceded a sharp upward breakout 8 out of the last 10 times it occurred. The platform flashes an alert, not just saying buy, but providing a statistical case study for why this otherwise invisible setup represents a potential opportunity. Now, it's crucial to address the elephant in the room. This can feel like a black box. The AI might highlight a pattern, but it can't always explain the fundamental economic or psychological reason why that pattern is predictive. It's simply pointing out a powerful statistical correlation it discovered in the data. This requires a mental shift for many traders, moving from a need to understand the why to trusting the what, the probabilistic edge revealed by the data. These tools are not about finding certainty. They will be wrong. They will have losing streaks. Their purpose is not to deliver a flawless prediction every time, but to consistently stack the odds, even if just by a few percentage points, in your favor over the long run. Seeing these hidden patterns and understanding the market's secret language is a monumental leap forward. But it also opens up a whole new set of questions. How do you actually execute based on this information? How do you manage your risk when you're acting on a signal generated by a complex algorithm you don't fully comprehend? Because having the world's best map is useless if you don't know how to drive the car. And that's precisely where the next layer of AI comes in, revolutionizing the very act of placing and managing trades. This is the moment where the rubber meets the road. It's where multimillion-dollar hedge funds and solo traders in their home offices face the exact same challenge. It's the gap between a brilliant idea and a profitable outcome. It's the split-second decision to click the button. And this is where more trading plans go to die than anywhere else. It's called execution risk, and it's the silent killer of countless trading accounts. Because the human element, with all its fear, greed, and simple fallibility, is often the weakest link in the entire chain. Let's paint a picture. You've done the work. You've used AI-powered chart analysis, you've checked the AI sentiment reports, you've even run backtests on your strategy. Everything is screaming sell on the British pound against the Japanese yen. The setup is perfect. It's an A-plus trade. Your finger hovers over the mouse, and then it happens. That little voice in your head. What if I'm wrong this time? What if that news headline I just saw matters more than I think? Maybe I should wait for one more confirmation candle. You hesitate for just 30 seconds. In that 30 seconds, the price drops 20 pips without you. The entry is gone. The opportunity vanished. The perfect plan, perfectly analyzed, resulted in zero. Or consider the opposite. You do take the trade. You click sell, and you nail the entry. The position immediately moves in your favor. You're up 50 pips, then 70. You feel like a genius. But you're at your day job stuck in a meeting. You can't stare at the charts. You tell yourself you'll check it in an hour. When you finally get back to your screen, a sudden reversal has wiped out all your gains and you're now stopped out for a loss. You had a winning trade, a validated plan, but because you couldn't manage it with robotic precision, it turned into a loser. These two scenarios, hesitation and mismanagement, are the twin demons of manual trading. They are emotional and logistical problems. And they are precisely the problems that AI-powered trade execution tools are designed to solve. Now, when I say AI execution, I need you to erase the image of some black box that you just turn on and hope it makes money. That's not what we're talking about. We're talking about a co-pilot, a tool that takes your strategy, your rules, and your risk parameters and executes them with the cold, calculating, and unemotional precision of a machine. You are still the strategist, the general deciding on the plan of attack. The AI is your elite special forces unit that carries out the mission flawlessly, 24 hours a day, without ever feeling fear or greed. So how does this actually work? Let's break down the layers. The first and most fundamental feature is what we can call intelligent order entry. A standard brokerage platform lets you place a market order, a limit order, or a stop order. It's basic. An AI trade manager takes this to a whole new level. You can create a set of complex, if-then conditions for your entry. For example, you could instruct the AI, I want to go short on the euro to US dollar, but only enter the trade if the price breaks below yesterday's low, and the 50-period moving average is angled down, and this happens during the London session. If these conditions aren't met by the end of the day, cancel the order. Think about that. The AI is now your tireless scout, watching the market for the exact, perfect conditions you've defined. You don't have to be glued to the screen. You can set up these advanced orders across 5, 10, or 20 different currency pairs and let the AI do the waiting. It frees you from the screen and eliminates the risk of impulsive, suboptimal entries. But getting into the trade is only half the battle. Managing it is where the real skill and the real potential for AI enhancement lies. This brings us to the concept of dynamic trade management. Your standard stop loss is static. You place it 30 pips away and it just sits there. But the market is not static. It's a living, breathing thing. So why should your risk management be so rigid? AI tools introduce intelligent, adaptive stop losses. The most popular version is a volatility-based trailing stop. Instead of trailing the price by a fixed number of pips, the AI calculates the market's current volatility using an indicator like the average true range, or ATR. In a quiet, calm market, it might keep the stop loss tight. But if the market suddenly becomes wild and choppy, the AI will automatically widen the stop loss to give the trade more room to breathe, helping to prevent you from getting shaken out by meaningless noise. It adapts your risk in real time based on actual market conditions. The same intelligence applies to taking profits. Why settle for one single take-profit level? An AI trade manager can execute a sophisticated scaling-out strategy for you. You can program it to, once the trade is 50 pips in profit, close 30% of my position and move my stop loss to my entry point, making the rest of the trade risk-free. Then, at 100 pips of profit, close another 30%. Let the final 40% run until the trend reverses. To manage this manually, especially if you have multiple trades open, would be a stressful, full-time job. The AI does it automatically while you sleep. Perhaps the single most powerful feature of these tools, however, is automated position sizing. This is the bedrock of long-term survival in trading. Ask any professional, and they'll tell you that managing risk is more important than picking winners. Most new traders risk way too much on a single trade, and they do it because calculating the correct position size is tedious. You have to know your account balance, your desired risk percentage, the distance to your stop loss, and the pip value of the specific pair you're trading. It's a lot of math and it's easy to make a mistake. With an AI trade manager, you simply state your rule. Your rule could be, I will never risk more than 1% of my account on any single trade. That's it. From then on, every time you go to place a trade, you just set your entry and your stop loss on the chart. The AI instantly reads your account balance, calculates the distance in pips, and automatically adjusts the trade size, the lot size, to ensure that if your stop loss is hit, you will only lose exactly 1% of your capital. Not 1.1%, not 5%. Exactly 1%. This feature alone can be the difference between a minor drawdown and a completely blown account. It enforces discipline when human emotion is at its weakest. When you combine these elements, intelligent entry, dynamic trade management, and automated risk calculation, something remarkable happens. The trader's role begins to shift. You spend less time being a frantic button pusher, stressed about every little tick of the price, and more time being a high-level strategist. Your job becomes finding the A-plus setups, defining the rules of engagement, and letting your AI co-pilot handle the minute-to-minute battlefield execution. It removes the guesswork, the fat finger errors, and the emotional roller coaster from the mechanical act of trading. This is the true power of AI in execution. It creates a buffer between your human analysis and the chaotic market, a firewall of logic that executes your plan without deviation. It ensures that the performance of your trading account is a true reflection of the quality of your strategy, not the quality of your emotional state on a given Tuesday. So now the system seems incredibly robust. We have AI to analyze the charts and find the opportunities. We have AI to gauge the market sentiment. And now we have an AI co-pilot to execute our plan with machine-like precision. Feels like the complete package. We've built the perfect trading machine. But there's one final crucial piece missing. A machine that only follows orders is just an automaton. The real leap forward, the one that separates good from great, is a machine that can learn. What if this entire system, your analysis, your execution, your results, could be fed back into an AI that learns from your every move? What if it could analyze your personal trading habits, identify your unique flaws, and show you the hidden patterns in your own behavior that are holding you back? That's not just automation anymore. That's personalized evolution. And it all starts with reinventing the most overlooked tool in a trader's arsenal, the trading journal. For decades, it's been the dusty, forgotten book on the shelf, the neglected spreadsheet with half-filled columns. It's the one piece of advice every professional gives, and the one piece of advice 99% of developing traders ignore. Why? Because it's tedious. It's painful. It's a constant manual reminder of every single mistake you've ever made, with no clear path to fixing them. We tell ourselves we'll do it later. We log the big wins to feel good, but conveniently forget to detail the crushing losses. It's a chore rooted in discipline, and our brains are wired to avoid it. But what if the journal wasn't a chore? What if it wasn't just a record book, but a strategic partner? What if it could do the heavy lifting for you, and instead of just showing you what you did wrong, it could build a data-driven roadmap showing you how to do it right? This is the reality of AI-powered performance analytics platforms, the modern evolution of the trading journal. These aren't just digital notebooks, they are cognitive mirrors, reflecting your trading habits back at you with brutal mathematical honesty. They operate on a simple revolutionary premise. You can't fix a problem you don't know you have. And most traders are blind to their own worst tendencies. Here's how it fundamentally changes the game. First, it eliminates the single biggest barrier to entry, the manual labor. Instead of you spending hours after a trading session typing in every entry price, exit price, stop loss, and currency pair, these platforms connect directly to your brokerage account via a secure API. Every single trade you take is automatically imported, in real time with dozens of data points. The moment you close a position, it's already logged, categorized, and analyzed. The chore is gone. The discipline is automated. What's left is pure, unadulterated insight. And that's where the AI truly comes alive. A traditional spreadsheet might tell you your win rate. That's basic. An AI journal will tell you your win rate on Tuesdays, between the hours of 10 a.m. and 11 a.m. Eastern, specifically when trading the euro to US dollar, on days when the VIX is above 20. It will show you, with statistical certainty, the exact conditions under which you historically perform best, and the exact conditions that are a minefield for your strategy. Imagine getting a report at the end of the week that doesn't just show your profit and loss, but tells you a story about yourself. It might say, your highest probability setups occur after a 20-pip pullback on the 15-minute chart, but only during the London session. However, you consistently give back these gains by entering FOMO trades during the New York Open, where your win rate drops to a mere 32%. This isn't a guess. It's not an opinion. It's your own trading history, processed through a machine learning algorithm, revealing the hidden architecture of your success and failure. These platforms are masters of pattern recognition. They can identify things the human mind would take years, or even a lifetime to notice. For example, it might find that your average winning trade is held for 45 minutes, but your average losing trade is held for 3 hours. What does that tell you? It's a data-driven signpost pointing directly to a weakness in your trade management. It suggests you're cutting your winners short and letting your losers run, one of the most classic and destructive retail trading habits. Seeing it spelled out in black and white, with your own data as proof, is a powerful catalyst for change. Let's take a case study. A trader in Chicago, let's call her Sarah, was struggling with consistency. She felt like she'd have a great week, followed by a terrible week, and could never get ahead. She connected her account to one of these AI analytics tools. After 2 weeks, the AI produced a startling insight. It had analyzed the tags she applied to her trades, tags like trend following, breakout, or reversal. The data showed that her trend-following trades were profitable over 70% of the time. But her reversal trades, the ones where she tried to pick the top or bottom of a move, were profitable only 25% of the time and were responsible for every single one of her large losing days. Sarah thought she was a versatile all-around trader. The data proved she was an excellent trend follower and a terrible counter-trend trader. The AI didn't tell her to stop trading reversals. It just presented the cold, hard facts. Armed with this knowledge, she made a simple rule. She would only take trades that aligned with the higher time frame trend. Her profitability curve began to change. The AI didn't give her a new strategy. It revealed the profitable strategy she already had, buried beneath the noise of her own bad habits. In the United States, several platforms have become popular for this very reason. Tools like TraderView, for instance, are known for their deep, granular analytics and community features, allowing traders to share their data and insights. It's a powerhouse for those who love to dive deep into statistical analysis. Then there's Edgewonk, which focuses heavily on the psychological aspect, helping you journal your emotional state and identifying the mental errors that lead to financial ones. It acts like a trading psychologist, categorizing your mistakes into buckets like over-leveraging, revenge trading, or exiting too early. Over time, it builds a psychological profile of your trading, showing you which mental traps you fall into most often. Another platform, Chartlog, is praised for its visual interface, overlaying your entries and exits directly onto charts, making it incredibly intuitive to review your trades and see exactly where you went right or wrong in the context of price action. The key takeaway is that these tools transform journaling from a passive act of recording history into an active process of self-discovery and optimization. They run on what's called a feedback loop. You trade. The AI analyzes your trades. It provides you with data-driven insights. You use those insights to adjust your approach. You trade again. The loop repeats. Each cycle, you are potentially refining your edge, chipping away at the behaviors that cost you money and reinforcing the ones that lead to better outcomes. This is a profound shift. For years, traders have focused almost exclusively on analyzing the market. They analyze charts, they analyze news, they analyze indicators. But they rarely, if ever, apply that same level of rigorous, data-driven analysis to the single most important variable in the entire trading equation themselves. Your strategy is only one part of the puzzle. Your execution, your discipline, your psychological state, that is where the real edge is found or lost. These AI platforms are the first tools that allow the average retail trader to analyze their own performance with the same statistical rigor that a quantitative hedge fund would use. They take the guesswork and the emotion out of self-improvement. It's no longer about a gut feeling that you trade badly in the afternoons. It's about a dashboard showing you that your profit factor between 1 p.m. and 4 p.m. is a negative 0.5. You can't argue with the math. So we've now journeyed through the AI landscape. We've seen how AI can help us find our edge in the market with advanced charting and pattern recognition. We've seen how it can help us execute that edge with more precision and less emotion through automation. And now we've seen how it can help us refine that edge by analyzing our own performance with an AI-powered journal. We've analyzed the market, we've analyzed our execution, and we've analyzed ourselves. The loop seems complete. But what if it wasn't? What if this was all just a precursor to the final step? What if you could take the market analysis, the automated execution, and the self-correcting feedback loop, and fuse them all together into a single cohesive learning entity? A system that doesn't just follow rules but creates them? A system that learns from the market's behavior, and from your behavior, all at the same time, to forge a strategy that is uniquely, dynamically, and perpetually yours. That is the final frontier of AI in Forex trading. And it's where we're going next. This isn't about an off-the-shelf solution you download. It's about a fundamental shift in the relationship between trader and technology. Think of it this way. For decades, traders have been like drivers using a standard GPS. It gives you a route, warns you about traffic ahead, and recalculates if you miss a turn. It's helpful, it's reactive. But the world's best Formula One driver doesn't just have a GPS. They have a race engineer, a whole team connected to them in real time. That engineer isn't just looking at the track map. They're monitoring engine temperature, tire degradation, fuel consumption, the weather, the strategies of every other car on the track, and most importantly, the driver's own performance and feedback. They don't just give a route. They co-create the entire race strategy, adapting it second by second. That is the final frontier. We're talking about generative and adaptive AI trading co-pilots. These systems are not just executing pre-programmed rules. They are designed to learn and evolve on three distinct levels simultaneously. First, there's the market. These systems ingest a colossal amount of data, far beyond simple price charts. We're talking about real-time news sentiment analysis from thousands of global sources, parsing the language of central bank announcements, tracking institutional order flow, and even correlating seemingly unrelated datasets, like shipping movements or satellite imagery of oil reserves. It builds a multi-dimensional, high-fidelity model of the market that is constantly updating. It doesn't just see a trend. It seeks to understand the complex web of causes behind that trend. Second, there's strategy generation. This is the generative part. Instead of you testing one strategy at a time in a backtester, the AI runs millions of microsimulations in the background. It's constantly creating, testing, modifying, and discarding potential strategies based on the live market model it has built. It might combine a scalping technique popular in the Asian session with a risk management parameter derived from recent volatility in the European session, creating a hybrid strategy that a human might never conceive of. It's a relentless engine of innovation, constantly searching for a new edge. But here is the most profound and game-changing level: it learns you. This is the adaptive part. The system analyzes your trading history, but not just your wins and losses. It analyzes your behavior. It learns that you tend to cut your winners too short on Fridays. It recognizes that you have a higher success rate with counter-trend trades in low volatility environments. It sees that you get trigger happy after 2 consecutive losses and are more likely to enter a low probability setup. It learns your psychological fingerprint as a trader, and then it integrates all 3 levels. The result is a co-pilot that doesn't just give you a generic signal. It gives you a personalized, context-aware suggestion. It might say, market conditions suggest a potential long entry on the euro/dollar. However, my analysis of your past performance shows a tendency to over-leverage in similar setups. I recommend a position size of 0.5 lots to align with your historical risk-to-reward sweet spot. Or, high-impact news is scheduled in 30 minutes. Your trading history indicates a 70% decrease in profitability when holding positions through this type of event. Consider closing the current trade and observing from the sidelines. This isn't about taking control away from you. It's about giving you the ultimate advisory board, one that knows the market, knows strategy, and knows you personally. It's a system designed to mitigate your specific weaknesses and amplify your specific strengths. It's the race engineer whispering in your ear, "Easy on the tires in this corner. Push hard on the next straight." Now let's be absolutely clear. This technology is at the bleeding edge. It exists primarily in the high-frequency trading firms and elite hedge funds, but the components are becoming more accessible. the APIs for sentiment analysis, the cloud computing power for mass simulations, the machine learning frameworks, they're all out there. And we're starting to see the first wave of retail-focused platforms attempting to build these integrated co-pilots. This brings our entire journey full circle. We started this series by looking at simple signal providers and basic bots, tools that operate on a single layer of logic. We moved on to advanced analytical platforms that help you, the human, see the market more clearly. We then explored automated trading systems that execute your strategy with perfect discipline. Each step represented a deeper integration of technology, but they were all still tools that you wield. This final concept represents a new paradigm, a partnership. The AI handles the infinite complexity of data processing and the cold, hard logic of probability. You, the trader, provide the human element, the strategic oversight, the intuitive gut feeling, the final risk assessment. You are still the CEO of your trading account. The AI is your chief operating officer, handling the day-to-day tactical execution and analysis, freeing you up to focus on the big picture. So, what does this mean for the average trader in the USA right now? It means that the skill set for success is evolving. 10 years ago, the edge was in finding a secret indicator or a clever entry technique. Today, and increasingly into the future, the edge will come from your ability to effectively partner with technology. It's not about whether you can code a complex algorithm yourself. It's about whether you can ask the right questions of the AI. Can you correctly interpret its suggestions? Can you manage the psychological dynamic of working with a system that knows your flaws better than you do? Do you have the discipline to listen to its advice when your emotions are screaming at you to do the opposite? The future of trading isn't a world without human traders. It's a world of augmented traders. The person who can master this human-machine symbiosis will be the one who navigates the markets of tomorrow. This technology is not a replacement for knowledge. In fact, it demands more of it. You need to understand the fundamentals of the market to even know if the AI's suggestions make sense. You need to understand risk management to set the foundational rules within which your AI copilot operates. You can't delegate responsibility. The AI is a powerful tool, but like any tool, its effectiveness is determined by the skill of the person wielding it. As we conclude this series, the key takeaway is not a specific brand name or a best tool. It's an understanding of the trajectory we are on. From simple alerts to hyper-adaptive, personalized copilots, AI is fundamentally reshaping what it means to be a Forex trader. The journey is moving from finding information to managing intelligence. The question you should be asking yourself is not, which AI bot should I buy? The question is, how can I start to incorporate these layers of technological leverage into my own trading process? Maybe it starts with a sentiment analysis tool to add context to your trades. Maybe it's using an advanced backtester to more rigorously test your ideas. Or maybe it's just using a sophisticated trading journal that tracks your psychological state along with your P&L. The final frontier is here. It's not a single product, it's a process. It's a commitment to evolving alongside the technology, to becoming that driver who knows how to work with their engineer to win the race. The tools are getting smarter every single day. The real challenge and the greatest opportunity is for us to do the same.